If somebody's doing commission trading, run. I mean, let's face it. If they're doing commission trading, you'll never know if they make a trade that benefits your portfolio or benefits their pocket. Mm-hmm. There's no way of knowing. So you may see a lot of trading in there, and essentially what they're doing is they're taking your portfolio and running in circles with it.
Right.
All right, welcome back to our second episode of Distilled Assets. My name is Jaimin and Rebekah. I am a financial advisor, owner of Assurance Wealth Management, Assurance Insurance Services, and Assurance Family Office. To my right is my lovely wife, Rebekah.
Mm-hmm. And I am the operations manager of, I guess, all of those companies.
Of them. Yes, and so for those of you who just joined us for the first time, this is our journey in sharing with everybody real-life scenarios of working with financial advisors, questions that you should ask, what to expect, just the whole journey of financial life and literacy, but trying to tell it from a less Wall Street perspective and more of you're hearing it from not just a financial advisor, but a business owner, a father, a husband, and how we implement a lot of this in our daily lives as well. Mm-hmm. Now, I know a lot of people on their journey to find a financial advisor tend to be pretty hesitant at the beginning, not know what to look for, not sure what to expect. A lot of times don't even know if they need an advisor or if they should have one. There's a lot of hesitancies, and we start to hear a lot of the same things over and over from these people. So I think what we're going to want to do today is go through with you guys, kind of debunk some of the myths of financial advising. We want to give you some ideas of what to look for, both good and bad, all your red flags, green flags. And we want to give you a real life example of a couple that came in here recently and what they did starting their financial journey or their journey of looking for a financial advisor, what made them decide that they need to start looking, kind of where they're at in the process right now and what that looks like. Mm-hmm. And then their aha moment, I think, that they had kind of at the end of the meeting with us the first time that we met. So I think we're going to have a lot to go through today. We're never know how long these things are going to go, but we're going to try to get a lot of information into a short period of time. As always, I need to start off by, appeasing the SEC and lawyers and compliance officers and whoever else out there may be listening. This is not financial advice. I'm not your financial advisor right now. Please don't take anything that we say and go out and run with it. This is all for educational purposes. Please consult a professional in either taxes, estate planning, or finances, whatever it is that we say that you want to take off and run with. Go talk to a professional first. Don't just go do it yourself, because everything that we go through on this podcast is designed for education. Mm-hmm. We're just trying to help people out. This is just another avenue for us to educate, which is something we love doing. So let's start by talking about, John and Jane Doe that came in recently, and let's kind of give them a background of who these people are and what opened their eyes to start the process of looking for a financial advisor. I mean, I can give you the basics of he's a business owner, owns multiple businesses. His wife has recently left her full-time job to raise the kids as well as try to help with the businesses and learn that aspect of things. He's the type of person that is very go, 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 sometimes to a fault, that he's got a lot of plates spinning at once.
Sounds familiar.
In more than one case. It's not just me. I don't know if you've noticed. We've got a lot of business owner clients that are the same way. But always trying to improve his businesses, always trying to do something new and make sure that it's something that can benefit his business or benefit his family. But I don't think that he would have ever come to the realization, maybe he would have, just not when they did.
Not in this time frame, no.
Yeah, of maybe we need to talk to somebody about this stuff.
Yeah.
Because I think he was pretty content, as most business owners are, of just pushing forward with the businesses. But you had a pretty unique interaction with her, I think, in our first meeting, where he was talking to me about a lot of the business minutia and details and tax strategies and all that kind of stuff that they're trying to implement and what they're trying to do with everything. But you and her kind of had a little sidebar conversation where I think she was a little bit more candid with you in releasing why they're even sitting down with us.
Yeah, so I think every woman's had this dream where your spouse passes. And in their situation, he is, like you said, he's a go-getter. He's got all these plates moving, and he had tunnel vision. It was, I like to work, and I want to just keep making money.
Yeah.
And that's wonderful. That's great. Kudos to him. From her point of view, there was too much going on. Mm-hmm. She didn't know where all the money was coming from. She didn't know how to balance it all. She didn't know where the money was going to. And so she had this dream that he died, and she woke up in a literal panic in the middle of the night with the realization that, yeah, financially they're fine, but he is the face of the company. He is the primary moneymaker. And she didn't know how to take the reins if anything should happen to him. Mm-hmm. And they had a high school kid in high school. And so there's talks of him going off to college. How do I fund that? How does that all work? Where does all this money go? And so she was essentially the one that said, all right, it's time to bring someone in that can take all of this effort that you've put in and create a plan that benefits me in the sense of growing the money we have now, but also making a contingency plan that if anything should happen to him, what does she do next? Mm-hmm. And their situation was a lot like ours, and they do have a lot of companies. And how did they do a buy-sell agreement? How do they deal with partners? What percentage does she get? If there's a buy and sell agreement, what do I do with that money that I get if I don't want to keep the company that would benefit myself and my son? And then the next step was they went and saw what I like to call an advisor in a box. We have ducks in a box, just someone. You just walk in and you talk to them. And that was their situation. They went to a well-known crutch firm, sat down with this individual, and this advisor, did something that altered even both their sides of outlook. If he's talking to the husband, she's sitting right there. He looks at her and says, I'll slow down for you. And for
very
both
condescending.
of them. Yeah. And for both of them, it was aha moment of we want someone that we trust. We want to have a close relationship. Because again, if anything should happen to him, she has someone that she can trust, that she's built a rapport with, that can call. They're not just in a bank account number or, a retirement number. It is, we know who you are. We know your situation. Don't you worry. We've got everything in place. Let's get the ball rolling.
And what I'm shocked by is that they even came and had a meeting with us after that incident. And the reason being is there are a lot of common hesitancies or objections to even talking to a financial advisor for the first time or working with one. And he meaning that other advisor, proved one of them to be correct in that situation. So, first of all, kudos on them for looking past that and not saying, okay, this is how all financial advisors are, and stopping there. Yeah. Kudos to them for moving forward, getting another opinion, going and talking to somebody else. But I want to address with you what some of those common things are. Yeah. I mean, because we both hear the different sides of it, right? I mean, I tend to hear the more business side of it. I tend to hear the more financial side of it. Mm-hmm. you tend to hear a lot more of the thoughts and feelings
Yeah, the
sides of
emotions.
things, the emotions side of it. So I know from my point of view, two of the very most common objections or hesitancies, if you will, are I can do it myself, meaning I can put a plan together myself. I don't need to pay somebody to put this together for me. And then the second one comes from the advising side or the investment side of things is, oh, I can build a portfolio just as well as an advisor. I've got all this, I've got Yahoo Finance and I've got, all these different websites that I can go to and do all the same research, and I can create the same portfolio that an advisor can. Those are two of the most common things that I hear from a business and finance and investment side of it. What are some of the ones that you hear from a personal aspect or emotional aspect?
I think I've touched on this. I don't know. Maybe it was in our announcement video or to other people. Your industry does not have the best reputation. When people think of advisors, they get that scared feeling of, I'm giving my money to someone that I don't quite know. And by giving money, I mean I'm allowing them
Trusting your
access
money.
into my, allow them to manage my portfolio. And what if they make a mistake? What if the market crashes and my portfolio is not built to hedge that? We don't have any hedging. Is that the correct way of saying that?
Yeah.
Trying to use your lingo.
So the first one being trust, just purely from a trust level.
Yeah.
Of, do I trust this advisor, or I don't trust the advisor on the onset because of the reputation of the industry. Okay. What else have you seen other than trust that people tend to have hesitancies? That's a tough word to say over and over with advisors.
I think there's a lack of communication.
Okay.
I think that when a lot of people's experiences is that when they start searching for an advisor, there is a lot of fluffing, a lot of love bombing, if you will, of I do X, Y, and Z. I'm going to do all these things. You're going to be fine. I'll take care of you. You agree to work with them, and then the communication essentially ceases, or there is a pretty big downfall. And I think that's where that also builds into, that connects to the lack of trust.
Okay.
And when I say communication, it does also go both ways. So I think from my experience, there is this legitimate worry of, I don't know what's going on with my retirement plan. And I think also there is this, the plan that they have does not flow with where they are. What you're experiencing at 35 is not what you're experiencing at 45 and 50 and nearing retirement. And your portfolio should change with that. And I think there's a lack of education as well.
Sure.
Advisors tend to do that, don't worry, I got you kind of thing. That's great. That's wonderful. But I do think that there is an importance with an advisor saying, do you understand this? And if you don't, I'm not going to use the financial jargon. I'm going to explain it in a way that you understand. And then to continue that as they grow. And I think for you and I, our biggest thing is educating.
Yeah.
And so that's what I've seen the most. It's the lack of trust, the lack of communication, the lack of education.
Okay. So let's break down kind of each one of these hesitancies. Got it that time. And what the reality is behind them. Okay. So let's start with, yes, you can do it yourself. That is one of the big ones. Is I can do it myself. I can create a financial plan or an investment plan myself. You absolutely can. Anybody can. With a little bit of knowledge and a spreadsheet, you can probably do a lot. But what all is included in a financial plan or working with a financial, and when I say working with a financial advisor, again, this is assuming you're working with a good one. So as you call them, advisor in a box, probably you can do just as much as they can on your own. Mm-hmm. That's probably true. But when you start getting down and working with financial advisors that do a full financial plan, that do a full retirement plan, that actually talk to you about everything that they should, they're not just managing a portfolio, that's where you start getting a lot more than what you can probably do on your own. And it's not saying that you're a dumb person. It's just, this is all they do all day, every day. Mm-hmm. I mean, you look at guys like Tiger Woods, one of the greatest golfers of all time. He still had a swing coach. He still had a coach telling him how to improve his swing on a constant basis. It's not something that just because you're good at means you don't need a little help. Right. You don't need some outside perspective. So what all is included in a true financial plan? Yes, your investments. Okay, you've got to have an investment portfolio. That is part of what they will do. Mm-hmm. Number 2 is you need it to be tax efficient. So understanding the tax laws that go along with not just your investments, but your distributions, and everything in between. If you have a business owner, that's a whole nother level of tax efficiency that you need to look at. We need to look at risk management. That could be insurance. That could be just asset management. That could be just protection strategies for your overall. You should look at retirement planning and everything that goes into that, because a retirement plan is completely different than a financial plan. Mm-hmm. There's so many nuances within a retirement plan: Social Security, Medicare, pensions, 401ks, distribution strategies. Again, there's a million things that go into that as well. So being able to do that. Another part of it, and I think one of the biggest part of it, is the behavioral side. When you're looking at investing, there's a million quotes out there and a million people that you can go and probably look at this. And when investors talk about what is the number one downfall of investors in general, mm-hmm. it is their emotional connection to their money and to their portfolio.
For sure.
It is their making knee-jerk reactions. It is making emotional decisions.
It's fear-based.
Tied to their money. Mm-hmm. Yeah. And so what tends to happen is when the market's going down, people get scared that they're losing money, mm-hmm. and they will tend to go to cash, and they'll pull out. Well, you've now pulled out after a big loss. Mm-hmm. And then they're so scared as it comes back up that it's just a fake out and it's going to go back down, mm-hmm. that they wait, then they get back in and they miss the entire rally back up to the upside. Okay. Because it's all on emotions. Mm-hmm. It's fear more than anything. And so having somebody help you and help you make unemotional decisions mm-hmm. when it comes to your money, that is one of the biggest reasons that even the most financial savvy people in the world still hire advisors. Mm-hmm. You look at all the wealthiest men in the world, they've all got advisors. And I say men and women.
Thank you for clarifying.
The wealthiest people in the world, the most successful people in the world, all have advisors, mm-hmm. all have coaches. And so there's a reason for that. Mm-hmm. And so the fact that a retail investor, somebody doing it on their own, that thinks that they can create the same type of plan, I would say 95 times out of 100 you cannot. I mean, I think in the history of doing this, have met 2 people that I can honestly say, and I told them, there's nothing we can do for you. Yeah. You've got it all. You've got everything perfectly lined out the mm-hmm. way you should. You know exactly what you're doing in every possible scenario. Mm-hmm. You don't need us. You don't need our help. You don't need to be paying for our services. Now, the only reason that one of them decided to work with us was he just didn't want to do it anymore.
Well, I think it also takes time.
Yeah, it takes a lot of time.
I mean, imagine you could be, let's say you're retired. And
Surfing.
instead of you managing
Golfing,
it,
traveling.
instead of the client managing their own portfolio, it's you doing it. Because instead of them going and surfing and playing golf and all this stuff, what are they doing? They're sitting there in front of the TV. They're watching the market. They're doing their research. They're trying to figure out how to do all of this when it's, here's a person who can do it. And just continue living your life and check in and have someone be able to explain all these things to you.
And you got to think about the amount of research that goes into creating a portfolio properly and the amount of research that goes into creating a tax efficient strategy and the amount of research that goes into creating a proper estate or legacy plan.
Yeah.
There's a reason that those are 3 different professions.
Right. And it's not a one and done kind of thing. It's every year.
Yeah, and well, a lot of that is every year. Some of it is done as tax laws, as
Every
estate
4 years.
laws, as rules and regulations change. So there's a lot to be done and a lot of research. And while I think there's plenty of people out there that are smart enough and capable enough of keeping your own financial plan and doing your own financial plan, why would you want to waste the time, in my opinion? Why would you want to waste the time doing the research of 3 different professionals when you could just hire one and know that they are either going to be as efficient or more efficient than you are, have as good of a portfolio or a better portfolio than you are, and that extra time and that extra efficiency and those extra profits from the investments will more than pay what you're paying them.
Right.
So you are going to be net up time, energy, money. I mean, hypothetically, on all of these situations that you're dealing with a good advisor, you should be net profiting in multiple ways by paying somebody to do this for you. So big complaint, or not complaint, biggest hesitancy, number 1, of I can do it myself. I agree. You absolutely can. But why would you?
Right.
Why would you? Especially if you aren't educated and prolific in estate laws, tax laws, and financial planning.
Yeah.
Because it takes all 3 of those.
Right.
So I think the next kind of major hesitancy we get is part of what we just talked about, which is that investment portfolio. You know, you and I, or you hear me talk about this side of things a lot, because this is something that kind of pride myself on. I enjoy making the portfolios, love making the portfolios.
Yes.
I traded, through college, paid for a lot of my college with trading.
Well, you're a perfect example of someone who could do it and did it successfully.
Yeah. And so there's a lot of common mistakes, though, that do-it-yourselfers make. And I will be the first to admit, I made some of these.
Oh, yeah.
I made some of these, when I was in college and just out of college. Like, I did it too. The first one is a little bit of what we talked about with the emotional. The buying high, selling low. The market's constantly fluctuating, and they get emotional about the trades and end up selling at the wrong times and buying back at the wrong times. And then you're taking 70% of the hit, but missing 70% of the ride back up because of this. The second thing that I think people do wrong a lot is not building that portfolio to be real tax efficient, right? There's a lot of ways of building a portfolio, and depending on the type of account you're in, taxes are treated differently. So understanding that side of things is a little tough for people. The next one is people tend to, especially within the last 10 years, chase a lot of trends. I mean, how many times have we seen all these meme stocks, the crypto craze, buying the GameStop and seeing that come crashing down, or what was the most recent one that they just did? The girl that became a big sensation on YouTube for something stupid, and then she opened up her own. crypto coin.
Oh, she was the. I might not be thinking of the same girl.
The Haktua girl.
Haktua. Okay, honestly, I was like, is that the person I was thinking
Yes,
of?
the Haktua
apparently
girl.
She's on the run.
I don't know. I've heard a bunch of different things, but she opened up her own cryptocurrency coin and was selling it. Sold, I think sold like a couple $100,000 worth of it or something like that.
Is it bad?
And then shut it down.
Yeah.
Like it was just, she apparently.
She didn't know what she was doing.
Yeah, and I don't know that it was intentional.
I don't think it was her fault. I think she was sold on it, and it was, absolutely, slap my name and my face on it, and then it was, this is a bad idea, and damage had already been done.
Yeah, and it's a prime example of these memes that people are seeing online and trying to get on the new hot trend and investing in something and then losing your shirt over it.
Yeah, I don't think I ever expected my job for me to say to clients, please do not take advice from anyone on Instagram, TikTok, Facebook, any sort of social media. And if you do have a question, send it to me. Because
if they're not taking advice from any of them, how are they going to see us?
from someone who doesn't have a degree in it.
Or licensed.
Yeah, okay. Just because someone has made a lot of money doesn't mean you need to go and take their advice. Like we say with us, please do not take what we say at educational purposes. Do your
homework.
Research.
And it makes me think of a couple of different movies where it's not even the memes necessarily nowadays, but there's been a lot of trends over the years that people have jumped on the wagon and then it just crashed. Mm-hmm. And that's a big problem. The one that ties in the other kind of next point of do-it-yourselfers' big mistakes is tied to that, and it's the overconfidence effect, where, hey, I got into Bitcoin, made a ton of money on Bitcoin. So then I've got this overconfidence that every one of these things that I'm going to do like this is going to be right. And so what tends to happen is, hey, I made a couple of good trades, made a bunch of money. Now I'm going to double down, kind of throw risk management out the window because, I'm that good. And they'll start, okay, let me now sink a bunch of money into, whatever the next coin is, or whatever the next meme stock is, or it might not even be a meme stock or a coin. It could be just a legitimate company, but they throw risk management out the window and they say, hey, I'm going to put half my portfolio into Tesla. And then Elon comes out and does everything that he's been doing lately. And because of it, they've had like 48 attacks on Tesla companies, and Tesla stock is, there's no telling what's going to happen.
Yeah.
So when you get overconfident and you start throwing risk management out the window, that's when you start losing a bunch of money. And I'm not saying that's going to happen with the people that invested in Tesla by any means. I think that's a whole nother story. But I'm just trying to give an example of you getting overconfident in a couple correct trades, throwing risk and management out the window, start investing into other great ideas. They're not all going to be great.
Right.
And you're mistaking, or a lot of people tend to mistake luck with skill. So be careful there. I mean, even Warren Buffett, known as one of the greatest investors of all time, he even says you need to have a long-term strategy. You need to, whether it's long-term holdings or short-term holdings built within a long-term strategy, you need to have a long-term strategy, not winging it when it comes to your investing. So I think that's where the investing on your own thing gets pretty dangerous. And again, not saying everybody's that way, because there are a lot of people out there that can do a lot of investments on their own and are very successful with it. I will say that when you're doing investments on your own, you may not know about different strategies or investments that are out there. You may not even have access to certain investments as a retail investor that a financial advisor would. And so there's a lot of strategies and investments out there that are unknown to most people because they don't have access to it, or because it's not a stock or a bond or an ETF. And a lot of those types of strategies can help you make a lot more money or can help you reduce your risk in your portfolio by a lot. So not knowing is also a big reason of not doing it on your own, because you don't know what you don't know. You may as well have some conversations with an advisor or multiple advisors, see what they're doing. And if they're building portfolios the same way you're building them, then do it on your own if you're doing good at it.
Right.
But if you find some advisors that are like, hey, maybe they don't build just a traditional stock bond portfolio, maybe you see what they have to offer and see if those added investments or strategies could benefit your long-term run. Make sense?
Yeah.
I think that makes sense. I hope I said a lot there, but I hope that makes sense. So we've kind of covered the do-it-yourselfers on a financial planning aspect. We've covered the do-it-yourselfers on just the investment side of things. Okay, so we talked about the do-it-yourselfers from an aspect of financial planning and creating your own plan, and whether that's a good or bad idea to do it on your own. We talked about the investment side of things and how do-it-yourselfers do that, and whether that's a good idea or not. And those are the ones, like I said, that I hear all the time. So those are the ones I tend to talk to people about.
Mine?
What do you tend to hear? I know trust was a big one, and we'll dig into that.
Once I can explain to them how we work, and that is a bunch of communication and education. Once I am able to get them to feel more comfortable, the next question typically is, what's the fee? What am I paying you to do this?
Yeah.
Because I think it's a big concern for people of, why am I going to pay you to do something if I can do it myself? Why I could just save my money. And like you said earlier, if you have a good advisor, they're making returns. Those returns will cover the fee. But what is the fee? And how is that structured? Because there are various ways. Correct.
There are.
And I'm still learning this.
Yes, there are a few different ways that advisors get paid. Let's go with the old school traditional way of doing it. The oldest traditional way of doing it is on a commission base, meaning I'm your advisor and I'm going to charge $20 for every trade that I make. Okay? So I make a trade, buy or sell, $20.
Okay.
That's how I get paid. So
that adds up.
Yeah, it definitely does. And I'm going to go through kind of my opinions on all these different pay styles. If somebody's doing commission trading, run. I mean, let's face it. If they're doing commission trading, you'll never know if they make a trade that benefits your portfolio or benefits their pocket. There's no way of knowing. So you may see a lot of trading in there, and essentially what they're doing is they're taking your portfolio and running in circles with it.
Right.
Potentially. I'm not going to say all commission advisors do that, but
there is a benefit for them, for the advisor to do that, correct?
Yes.
It seems like it's better
unethical.
for the advisor than it is for the client.
It's unethical and it's immoral, in my opinion, to do things that way. But not saying that all advisors that do that are unethical and immoral, if that makes sense.
And they can't be, I guess we haven't discussed.
I know where you're going with that.
Yeah. I guess we could talk about that in a second section, but they can't be.
We'll talk about that in another area. But the second way that advisors get paid or could get paid is hourly. I mean, you could pay by the hour.
Like
and
a lawyer?
Yeah, and they will sit down there and charge, tally up how much they're working and charge you for it.
Again, that will add up.
Kind of like you said with the attorney is, well, is that advisor going to charge you for every email? Is he going to charge you for every phone call? I don't know. Like I don't even know an advisor.
I didn't even know that was a thing.
I've never even met an advisor that charges this way. When we fill out our forms, for compliance purposes, they ask how you get paid, and that's one of the options that you could. Again, I don't know why anybody would choose an advisor that does that. But the next one is on a flat fee basis. So I'm just going to charge you $500 a month.
Regardless of what?
I don't know. So it depends on how they want to structure it. They could charge all their clients $500 a month. They could put people in tiers and say, hey, at this tier, we'll charge you $1,000. They can kind of set that up however they want.
Okay.
My hesitancy with that one is they know how, no matter how good or bad they're doing, they're getting paid. They know exactly how much they're going to get paid no matter how good of a job or bad of a job that they do. So from a business owner's standpoint, meaning the advisor, it's a great strategy because it's very predictable income. And no matter what the market does, no matter how good your portfolios are doing, no matter how much communication or little communication, you know exactly what your revenue is going to be. You know exactly what your income is going to be. From a client's point of view, are you getting $500 worth of service? Or is he meeting with you once every 6 months, once a year,
Right.
not making a whole lot of changes to your portfolio, but you're just paying $500?
Okay. I mean, you get what you pay for.
Could. Again, a lot of this is hypothetical because every advisor runs things a little bit different.
Okay.
And I'm sure with every one of these strategies, these fee strategies, there's good advisors and bad advisors.
Okay.
So take all of this with a grain of salt as far as this is just showing you what's out there.
Okay.
The most common way advisors get paid these days, and what I find to put you on the same side of the table as the client, is what's called AUM. So it's assets under management, and you get charged a percentage of assets under management. So that means as the advisors are doing good for you and making you more money in up markets, they get to benefit from that. They make more money. So they're on the same side of the table as you.
Okay.
And if the markets are going poorly, then your accounts are going down. So if the portfolio is created poorly, then the advisor is now losing money. He's got less money that he's getting. So yes, he's still getting paid because he gets a percentage of your portfolio, but that dollar amount has gone down. So is his pay. His paycheck has gone down versus the flat 500 or 1,000 or whatever the monthly fee is.
Okay.
So those are the different ways that advisors get paid.
As far as the AUM side, is that I know that some advisors, if I'm correct, will do a percentage across the board, regardless of how much money is in AUM. Some people tier it. Correct.
Okay. And there's arguments for both sides of this. Some people will tier it based off of how much money you have, that they will charge you less for the more money that you're putting with them. The argument that people have with that is, from an advisor's point of view, I'm doing the same work, whether you have 500,000 or 5 million. I'm, building your portfolio out. Now, the difference is that there are advisors out there that have different service models as well. So the more money you have,
the more to offer.
They will offer more services.
Okay.
Because at
You're
different
not
levels you're capable.
Portfolio-wise, correct?
No. Well, it could be portfolio-wise because there are investments that you can't get into unless you're at a certain net worth.
Okay.
So there is some of that too. But services as far as what the advisor does for you, that could change by your asset level of what they can do for you.
Okay.
So charging less on a percentage basis could make sense for some people. Charging that flat fee, same fee across the board will work for some people. It's just making sure that you, are getting the services that you think you're getting, that you're paying for. And then B, is that they are more than making up for that 1% or 2% or whatever their percentage fee is.
Right.
They are more than making up for that as far as not necessarily just in your portfolio, but in all the other things that they're doing for you.
Right.
Because I found more often than not that if you are paying for an advisor that only charges 0.5% and all they do is manage your portfolio, I would much rather more often than not get with an advisor that's going to charge me 1% for the same amount of money, but does the portfolio, does it in a tax efficient manner, helps me with my estate planning, helps me with my retirement planning, and they're not charging any extra fees for all those additional services. It's just all bundled in. That is going to be far more worth your 1% than it is to pay 0.5% for just a portfolio.
Okay.
My
And
opinion.
to
More
be
often than
clear,
not.
the national average.
1.25.
Okay.
1.2.
I just
something
want
like that.
people to like understand a base point. Like if you walk in, an advisor's like 2%.
Yeah, I haven't looked recently.
don't.
But I want to say it's 1.2
Okay.
ish, somewhere in there. And that's typically for. Actually, I don't even remember the range. I want to say that's like $1 to $5 million is like 1.2 or something like that. But then once you get higher, the averages go down because there's those advisors that have the sliding scale. So
Right. Okay.
But I want to say just kind of a base rate for most people. Just look for under 1.2, but
also factor in what are they
factor in
acting.
what services are they
Correct.
offering. So if it's just a portfolio, you better get way below 1.2.
And so that's what we kind of explained to people of here is our fee structure.
Yeah.
And we've had a few instances where they're like, I really don't want to pay that. And that's where we go into here is all that we offer.
Yeah, you're not just paying for a portfolio at that point. There's so many more things that go into it. And taxes are a big one. So if you can do some proper tax planning with somebody and say, hey, you've got $1 million. We're going to charge you 1%. Okay? So you're thinking that's $10,000 a year. Though the guy down the road is only going to charge me 0.7%. So $7,000. So I'm saving $3,000 by going to this guy over here. But all he does is a portfolio. We're over here doing tax planning that we're going to save you $15,000 per year in taxes.
Okay.
Who would you rather pay?
Right.
Pay the extra $3,000 to get $15,000 in tax deductions. There's a lot more that goes into it. So make sure that you're you know what services you're getting, not just a portfolio. B is that they can actually quantify that their fees are being more than made up for. So,
Okay.
And any good advisor should be able to sit down and break down the numbers of exactly what they're offering, what quantifiable number that service is providing to them, or a range or an estimate, something like that. If it's just, we'll save you a ton. What's a ton?
Right. That's subjective.
Yeah. So there's a lot that goes into it. But when it comes to the fee, make sure that you're within the ballpark of every other advisor that you talk to. Interview 3 or 4 or 5 of them. Make sure they're all kind of in the same ballpark. Make sure the services are the same. They should be able to show you some sort of performance history so that you can get an idea of, hey, if I just did this myself, here's what I've been doing by myself for the last 3 years or whatever. And with those performance histories, it's another caveat, is I will say be careful with performance histories, because what advisors will tend to do is they'll say, hey, let me take your portfolio. I'm going to plug in all the information from your portfolio. And I'm going to look at historically what that's done over the last 5 years, 10 years. Then I'm going to plug in what we would have had you in, which is what their current portfolio is. And then they're going to backtest that for the last 5 or 10 years and show you the difference between the two. Oh, see, our portfolio would have made you X amount more. Here's the problem. I can 100% of the time beat any portfolio that anybody ever brings me doing it that way. 100% of the time. Because do you know how easy it is to look at the last 10 years and 5 years and find the top 25 stocks and say that's what we would have had you in? Come on. That is such a terrible way of showing performance. You want to see actual performance, or you want to know the strategy that they're using and have an idea of that they have a step-by-step strategy for how they get in and out of positions.
Okay.
Don't ever trust here's what we would have put you in. Here's what you're currently in. We beat you. I'll tell you right now, Warren Buffett, Elon Musk, whoever, I don't care who you are, bring me your portfolio. I guarantee I'll beat it on one of those reports.
Challenge accepted.
It's not hard to go out and find the last 5 years or 10 years worth of top performing stocks and top performing bond funds and say, boom, I beat you. It's dumb. So don't trust those.
Okay.
You want to see actual performances, or if they don't have historical performances for one reason or another, at least know they have a written strategy for how they do their investments. So it's a rules-based strategy. Otherwise, they are winging it just like you are.
Okay.
So you want a rules-based strategy. That's you have to have that. That makes sense? Mm-hmm. I'm going to ask that a lot because I ask everybody that a lot. And I don't know. I just start talking.
It's okay. I'll tell you if you start converting to the other side.
To the dark side.
To the dark side.
All right.
All right. I have an argument to that.
Okay.
What if they, quote unquote, don't have enough money? Because the idea, what?
No, that's always a funny question. And we get that a lot.
It's the investing is for the rich.
Yeah.
How do you invest if you don't have any money? The question is, what is enough money?
That's a tough question. Yes, the mindset for most people is that financial advisors are for the rich. Mm-hmm. Investing, anybody can do. Mm-hmm. You can invest, is it Robinhood or whatever it is? You can, or Acorn or one of those.
Yeah.
Like, you can put your spare change from a purchase of groceries, round up, and the spare change goes into your investment account. Anybody can invest. Financial advising, on the other hand, I would say there's kind of a minimum that makes it worth it. And I don't know what that is because it's different for everybody's situation.
Well, some advisors won't.
There's a lot of advisors that won't work with you.
If you don't have X amount of money.
Correct. There's a lot of advisors. And there's nothing wrong with that from an advisor's standpoint because they may specialize in a certain niche. So they may not be good with the people that are trying to accumulate money, that are young. They may be we only deal with retirees that have $1 million or more because that's what they're good at.
Right.
So if you ever talk to an advisor and they say, hey, our minimum is X, don't be insulted by that. That just means that their specialty, what they're good at, is that level. Mm-hmm. So it's good that they told you that because then you can go find somebody that's good for whatever it is you're looking for. There's plenty of advisors out there that will work with anybody. There's plenty of those advisors in a box that I wouldn't say are financial advisors for everybody, but they are good at getting people started, at least investing for people that don't know anything about investing.
Okay.
So there's plenty of advisors out there that will take your $10,000 account or your $20,000 account and will invest it maybe better than you will if you don't have any knowledge about investing.
Okay.
As far as I don't have enough money for financial guidance, maybe not a financial advisor, but financial guidance, I would argue that with anybody, that everybody needs financial guidance. I don't care how wealthy or how poor you are.
And what does financial guidance look like?
Educating yourself.
Okay.
So learning more about different financial topics, whether that's through, we always talk about the website Investopedia. It's a great resource for people.
A lot of advisors hold webinars, seminars.
There's a million different educational seminars, webinars, YouTube videos. Although if you're going to do the YouTube video route or the social media route, make sure it is a financial advisor giving the information, not somebody who just flashes a Bentley and a Miami home and says, "Hey, do what I did." No, okay. Because
make sure they're teaching from an educational point, not a selling point.
Correct. But I think there's a million places out there to get knowledge, and everybody should, no matter what point you're at. And the sooner you do it, the better.
Right.
But yeah, I mean, the ones that I can think of right off the bat are Investopedia for your general knowledge. if you're looking for research for building portfolios and how to build them and whatnot, places like Yahoo Finance is pretty good.
Is that money market?
There's a place called Motley Fool.
There you go.
That's pretty good. There's a couple others out there that the websites are good informational websites. And so you can learn a lot from those.
I'm always on Vistapedia.
I know you are.
Because they do a really good job at explaining intricate things in a way. Because a lot of times when you start researching, there's so much jargon in it that you're like, wait, hold on. Now I have to go research what this means. And it's all connected and overlapped. And I think that in Vistapedia, for someone whose knowledge is pretty limited, they do a very good job. They also do a lot of videos.
Mm-hmm.
And
they do a lot of those little cartoon
I love
videos.
I love them. And I'll send them to our clients sometimes if I feel like I can't explain it. I'm like, go look here. They do a really good job.
Yeah. So I'd say from a guidance, from a knowledge standpoint, start now. Mm-hmm. You know, I don't care who you are, where you are, start now. And even the most savvy, again, educated investors, I know a lot of them that still are trying to educate themselves constantly. I mean, I've been doing this for over 15 years.
Constantly taking
My
a class.
dad's been in this for 40 years, so I've been around the business my entire life. Mm. I don't ever stop. I'm as soon as I finish one class, I'm taking another one. Just trying to learn more things. Or if I'm not taking classes, I am watching YouTube videos. I am, reading something about the markets. I'm constantly trying to educate myself because I know that there's always better ways of doing things. Mm-hmm. So why not learn that? Not just for myself, but for clients.
Yeah.
So I think that kind of wraps up a lot of those issues or questions about that. What is something else that you hear? I mean, I think you touched on one earlier that we haven't really addressed a whole lot is the trust, right?
Yeah.
I don't trust financial advisors.
Right.
I think that's rightfully so.
Yeah, you've even
sadly
admitted in the past of like we have that mistrust because we've proven we do have a bad history. I'm not saying all advisors are that way, but it is pretty known in your industry that your industry has
a bad rap.
Has a bad rap.
Yeah. And rightfully so. Mm-hmm. There's been plenty of advisors out there that have screwed people over. And I hate it. There's nothing I can do about it.
And it's made your job more difficult because oh my God, the rules and regulations are just insane.
Well, the regulations, and I don't even think the regulations are the hardest part of our industry. I mean, they're the most annoying, but I don't think they're the hardest part. The hardest part is building trust with somebody who walks in, rather than walking in with a blank slate where you can earn trust. Mm-hmm. Most people walk in with a sense of, I'm already a bad guy because of my profession.
Because they've been burned.
They've either been burned or they've heard stories of other people being burned or they've seen in the news about all these advisors that are going to jail for doing stupid things and running off with people's money and all that kind of stuff. Like, it's not even a blank slate for me to earn trust. I now have to fight those demons that somebody else created while trying to build trust and show them like, I'm not that. And from a client's perspective, why would you trust that I'm not that?
Right.
There's no reason for them to believe me. That's something that's earned over time. Mm-hmm. And so I think there's but there has been quite a big shift. I will say there's been a big shift in our industry of moving away from some of the practices that opened up the ability to screw people over. Mm-hmm. And there's most people going away from those commission-based fee structures. I think one of the big ones, and this is still a fight for a lot of people in our industry, is trying to make all firms fiduciaries. Now, that's a buzzword that's thrown around a lot, is a fiduciary, but I think it's one of the few buzzwords that's important. Mm-hmm.
Because I think it's important to know the definition.
Correct. So there are essentially two different types of rules that need to be followed.
Mm-hmm.
I don't know the name of the other one. I always call it the suitability standard, but it's I don't even think that's right. I don't know what it's called. But is essentially a standard that says as long as what we're investing you in fits your risk tolerance, then we can invest you in it.
Okay.
Okay. So if I've got two different options for investing, you're moderately conservative. Both of the investments are moderately conservative. One has a high commission, low returns.
Mm-hmm.
The other one has a low commission, high returns. I can put you in the one with a lower return for you, but higher commission for me.
Okay.
Because it's moderately conservative.
Okay.
So that is your bottom line seekers, the guys that are trying to pad the bottom line.
Mm-hmm.
The other one is fiduciary. I know the name of that one.
Because we are.
Because that's what I do. Basically, myself as the advisor and my firm are legally obligated to put the client's best interest above our own.
Correct.
Plain, easy way to explain it.
Mm-hmm.
So that's plain and simple what a fiduciary is. And so I think more and more advisors going that route is a good thing. Mm-hmm. Again, I've talked about how I came from a larger firm, not to be named, that when I found out a few years back that Congress was trying to institute something where all firms became fiduciaries, and a lot of these big firms sent lobbyists to go and fight that. Mm-hmm. It didn't sit right with me, is that you are spending money to argue to not do what's in the best interest of your clients.
Actions. Yeah, they proved.
So that's a big part of the reason that I left. But
and you saw what went behind closed
I saw
doors.
what a lot of advisors did that I didn't agree with.
Yeah.
But it's in the past. It's in the past. Little Rafiki there.
Your favorite movie.
It's in the past. So yeah, fiduciaries, fee advisors, talking about the percentage based on AUM. That's been a big part of it because you can't just churn trades for commission.
Right.
So I think those are two of the big important changes that have had. But when it comes to trust, it's something that's going to take time. And the questions I think that you need to ask advisors when you sit down with them to start building that trust is, A, are you fiduciary?
And don't take a, what did you say? You've said before, it's not a, like.
Yeah. Don't take a blow-off answer. It needs to be a direct answer.
Yes. It's a
yes,
yes or
we
no
are.
question.
Yes, we are. Ask them. I think another big thing is ask them how they invest. How do you invest money? What is your strategy? Is it rules-based? Do you have it written down so that I can see it? Those types of questions. Like,
does it have to be written down somewhere?
Well, if they're rules-based, they may not have like a fancy pamphlet to hand you, but they have it written down somewhere.
I didn't
so
know
that
if
they
it was
can
in
get
their
it to
like
you.
ADV or
No, it doesn't have to
policy
be there.
statements.
No, it doesn't have to be in any of that. It's usually because they can have it. Some advisors put it in their IPS, their investment policy statement. Some just have it in a notepad on their desk, so when they do the trading, they can follow the rules. So everybody's a little different when it comes to that, but they need to have some sort of rules-based approach to things. What else are other good questions to ask advisors right off the bat? Finding out if they sell products. Are they just there to invest your portfolio? Do they, some advisors believe annuities and life insurance are the devil. Some think they're the greatest thing and the only thing. Which way do they lean? And does it fit your beliefs?
Yeah.
My opinion is there is no product or investment out there that's truly bad. They all have a purpose. If they fit what you're looking for, If they fit your needs, if they fit your goals and your plan, use them.
Right.
If they don't.
Yeah.
So there's a lot of bad rap that annuities get for many different reasons. Are there bad annuities? Yes. Are annuities bad? No. They serve a purpose. If they fit your purpose, use them. If they don't. It's no different from any other financial product out there. So I'd say keep an open mind when it comes to investments or products or, different things of that nature, because as long as it fits your goal, that's all that really matters. What other questions do you need to ask right off the bat? What questions do we hear a lot right off the bat?
Well, they usually ask us what our services are. What are we going to provide?
Yeah.
How often are we going to communicate?
That should be in a list somewhere. They should be able to see that.
That should be in a handout.
Yeah.
Everything that is said to you should be written down and handed to you, because I just think that you are getting a lot of information told to you as a client, and you're trying to remember it all. And so I do think that having physical paper that you can take home and save is important, so that it's something that you can look back on. So if you're 6 months into this and my advisor's not talking to me, or every time I call, he's on vacation, but he says in this paperwork that he's supposed to be talking to me every 6 months, and we're supposed to do an end of year review, and I haven't done that. That allows you as the client to say, I'm not going crazy. They told me that they were going to do this, and they're not meeting the requirements.
Yeah. And I think communication's another big one, that to ask, how often do you communicate? Is this going to be a end of year review type of thing? Is this going to be in every quarter? Is this going to be every 6 months? Is it going to ramp up at the beginning and then kind of fall off? Like, what does communications look like? I think those are all very important questions to ask. But the last thing I'll say when it comes to trust of an advisor, they should know they have to earn it. They should know it doesn't just come in the first meeting. And when it comes to the client side of things, personality has a lot to do with it. I think if you guys have a good personality mesh and get along well in the first couple meetings, and they know what they're talking about, they're educated, they've got all these things that we named that they should have, you can give them a shot.
Yeah.
And remember, it's not a marriage. So, which is unfortunately a bad example to give these days, because I think 60% of those end in divorce. So, but it's not a lifetime commitment to an advisor.
Yeah.
I mean, you want it to be. If they're doing their job, it should be. But and make sure to ask them that question is, what's my commitment here? Like, are you going to be putting me in things that I can't get out of if I leave this relationship? Make sure you know all these different things, but know that you can. I think your personality, the initial framework of trust is there, and that they've got all these guidelines that we talked about as far as basics that they should have, and you give them a shot. 6 months down the road, if it's not working, leave.
Yeah.
I mean, as soon as you start feeling red flags, leave, or at least address them with them.
Trust your instinct. Like, if there's something that is bothering you, I'm not saying don't go have that conversation with your advisor, but because obviously I want you to. I want you to be able to feel comfortable enough to say, I don't feel like my needs are being met. You're unwilling to work with me. You're unwilling to meet with me. I feel like I'm putting on a back burner, whatever it may be. And I think I always emphasize research. And that includes researching advisors.
Very true. Brokercheck.com. I think it's .com. Brokercheck.org, brokercheck.com.
You can just Google it.
Something like that. Just Google BrokerCheck.
And you can put in the advisor's name, and they will give you their entire history if they have
disclosures. So what you'll see in BrokerCheck is if you look up an advisor's name, it'll show you all their history of disclosures. What disclosures are whatever. I just confused myself.
Brain fart.
Yeah, I don't know where I was talking there. What they are basically is a list of complaints that advisor has had, written or verbal complaints that have gone as far as maybe even a court or just gone to the SEC or gone to the state regulation board, but their disclosures on their complaints on that advisor and what ended up happening with that complaint. Sometimes you'll see that they get settled, they get filed, they go through court, the advisor wins or loses, whatever. You'll get to see their history of complaints. Now, I would like to say if an advisor has disclosures, if they have a disclosure or two disclosures,
Right.
they may not be the worst advisor in the world, okay?
I think you have to explain
Don't fear.
how those work.
I
Because
personally have no disclosures. Never have, hopefully never will. But
it is a
there
hard
are
one.
advisors that do have disclosures and they can't get rid of them. And they could get a disclosure for somebody just complaining about them, even if the complaint had no backing. So
It's like a Google review. Once you put it in there, you can't delete it.
yeah, so what I would do is if you see disclosures, but you really like the guy or girl, and they seem to know what they're doing, ask them about it. Hear their side of the story.
Yeah.
That's all you can do. And
Transparency.
if they tell you the story and they seem legitimate, and their story seems, heartfelt or fact backed, then make your decision there.
Right.
But at least do your homework on the advisor by seeing disclosures on broker check.
Yeah, because they have no way to argue it. And even if they weren't in the wrong, they can't scrub it. It's there. It's
Correct. And
That's a hard one, and I think even you and I are always terrified for.
yeah,
I
mean, and the other thing I'll say is make sure if it's a small firm to do a broker check on the firm. So if it's a boutique firm, do it on the firm. You'll see if the firm had any complaints. If it's one of your global firms, major wirehouses, it's pointless to do it on them because they are going to have hundreds, if not thousands, of disclosures because they have thousands and thousands of advisors for the last 100 years. There's bound to be complaints. So it's not going to tell you much because it's not going to tell you anything about the specific advisor at that firm that you're working with. So I wouldn't worry about the large firms' disclosures because there's just nothing they can do about it. And nothing as long as it doesn't relate to your advisor that really matters.
Yeah.
So I think that covers it as far as the trust.
Yeah, I'm trying to think.
So going through all of that, and a lot of that is kind of what we talked about with the John and Jane Doe that we were talking about. What would you say, because I kind of saw it in her face in the meeting, what would you say was the kind of aha moment where they're like, you know what, we do need a financial plan. We do need a financial advisor. We answered all of those questions that we just addressed with everybody to them. And they decided to, okay, let's start this process of creating a financial plan. Do you remember kind of what she said or what we were saying when she kind of it was kind of
like, oh, okay, yeah.
Yeah.
Or, where she felt like she wanted to give the green light.
Yeah.
Well, I think it was I validated her emotions. I validated that the feeling of chaos that was going to come if he died and she didn't know where all the money was, of like, that's valid.
Yeah.
And we can do that for you. We can set up, we can show you what a plan would look like if everything went the way that you wanted it to go. But we can also show you, the wife, what the plan would be in the event of his death or he became incapacitated. And how we would take care of her and we would take care of her son. I think one of the biggest things, the more I've thought about it, that kind of resonated with her was we like to run our company as a family. If you do not like us and you don't feel like you mesh well with us, that's okay. I'm not here to make everything sound wonderful and great.
No, because I think it works both ways.
Right.
I think you were interviewing us to see if we're a good fit to be your financial advisor. just as much as we're interviewing you to see if you're a good fit to be a client.
Yes.
And I think when we answered all those questions, got through all the initial part,
We talked.
that hour that we talked and answered all the questions about everything we just talked about. And then it came down to asking each one of them separately, kind of the way what you're saying to validate her feelings, but asking each one of them separately to have a separate answer of what is it that you want out of this.
And their answers were very different.
They were.
His was business oriented. How do I, expand my business? How do I expand into another business? And she was, how do I take
How do
care
I keep up with all this?
Yeah.
Yeah.
And
I
can
think,
my advisor explain all of this to me in a simple way? And
And
I
I-
was like, you can call me, you can email me. We have all of this information. We're constantly sending out, like I gave her a sample of our newsletter, a couple of our emails that we'd sent about tariffs.
the election.
And then we do questions you're afraid to ask, which she loved.
And I think it was just, the aha moment was kind of when we asked him, what do you want out of this? And he gave us his whole explanation. Mm-hmm. And we looked at her, what do you want out of this? Mm-hmm. And at that moment, she kind of realized that she doesn't have to just agree with everything he says. Mm-hmm. Like, she's got her own feelings. And we were validating that because a financial plan between a husband and wife is about both of them. Because if anything happens to one or the other, we need to make sure that everything's taken care of. Mm-hmm. But it's also about them as a couple.
Yes.
And making sure that their family financial aspect or family financial plan is all good to go.
Yeah, I think she felt like she was being irrational. And I think he was like, we have all this money. Like, we don't really have to necessarily worry about this. And she's like, but I worry about this because I worry that I wouldn't be able to continue down the road that you are, because you are the face of the company. You have designed all of this. And I don't have time to learn what you're learning because I'm over here picking up all these things while taking care of our son. And you and I said in the meeting, okay, great. We're going to take what you, John, want to do and you, Jane, want to do, and we're going to show you both, but we're also going to show you how they can meet in the middle. Mm-hmm. And I think that was for her she felt important. Yeah. She felt that her husband was being taken care of, his business was being taken care of, her side of being a wife was taken care of, and the side of her being a mother was taken care of. Mm-hmm. And I think that was, for both of them, it was, everything, all these points that we were worried about and we had different views are going to be taken care of in one swoop.
And it was far more than just a portfolio.
It was a lot.
So, yeah. And I thought it was a great meeting them. It was great going through the whole process with them. Yeah. Definitely look forward to what they've got in store for the rest of their life and his businesses and whatnot, because I think it's pretty cool to watch. I think I get the most enjoyment out of watching people just release. Like, we've got this plan. Mm-hmm. We know our plan. We know step by step what we're doing. Mm-hmm. We've got our guardrails that we know. As long as we stay within these guardrails, everything is going to work out the way we want it to. And once they have all that and they see it right in front of them, they're just like,
yeah,
just that exhale. Just all right.
My favorite is when they hit the goals.
Yeah. When we have the goals listed out and we start working towards each one. And then the
next, when you sit down with them and you're like, okay, you met all your goals.
Now what?
And
let's think bigger.
What's interesting is, most of the time they're like, okay, so I was thinking of doing this. Yeah. And I'm like, let's do it. Let's figure out how we can make that happen.
Yeah. So it was fun. It was a fun journey with them, and it's a very common one, right? Maybe not everybody has businesses, and maybe not wife's worried about taking over the business, but everybody's got their own fears. Everybody's got their own goals. Everybody's got their own plan of what they want things to look like, but they
all struggle how to implement it.
Correct. They struggle how to implement it, but they also don't necessarily know strategies or the right investments or hey, I'm investing in this way because I think I'm aggressive or I think I'm conservative or whatever it may be. But seeing, hey, we've got guardrails that as long as we stay between, this rate of return and this rate of return.
Oh, yeah. That's my favorite.
You're going to hit your goals. Like, we don't need to freak out about knee-jerk reactions to tariffs or the market dipping 10 or 20% because we know that, look, we're staying within our guardrails. As long as we stay there, there's no reason to freak out. So it gives you a real peace of mind, I think, more than anything once you have a proper financial plan in place. Is that fair to say?
Yeah, I think definitely we should focus one time on what a retirement plan kind of looks like what all entails.
Retirement or financial?
Both.
Remember, financial plan is kind of here, and the retirement plan is a whole nother animal.
I do think that there should be both because I didn't know that there was a change.
Well, and maybe we'll do that. Maybe in a future episode, we will break down the differences or go through what one looks like or what should look like.
And when to
implement each.
Yeah,
we can do that. I think we already have something on the store for the next episode, though, so we're not going to do it quite yet. Because
this one's more intricate to me.
What?
Are you talking about the families with special needs children?
Yeah.
I think that
we had a special request from someone to discuss what it looks like to do a financial plan with kids with special needs or family members with special needs, because it works kind of the same way. So that is going to be the next episode. That is going to be obviously an episode that will help not necessarily the general public, but more of that scenario.
Yeah. So if you have questions regarding that, or you have input, here's something that I did. I really do want to implore people to share that information and ask those questions.
Absolutely. So feel free to reach out to us, email, comments, whatever, and let us know if you've got any information on that topic or special situation that you've had that you saw work out great if you use a certain strategy. Just again want to thank everybody for joining us today. I think we went through a lot. We probably could have dove an hour deeper into each one of those topics, but we're not going to do that to you. Not yet, at least. We will probably down the road, but for now, we'll touch on that right there. But thank you guys for watching, listening. Here's where I ask you guys to all do the social media thing. Like it, share it, comments, subscribe, ring the bell, follow, send it to somebody else.
Look, whatever button is there, press it.
Help us because we don't know what you guys want to know more about or what's helpful to you. So the more that we get likes and subscribes and comments. Let us know what you enjoyed, what you don't enjoy. Let us know what questions you have about what we talked about. If you want us to reach out to you offline, let us know that. You can always email us. If you want us to talk about a certain topic on here, let us know that. If we've already talked about it on maybe a YouTube video or something else that we do, we'll send you the link to that so that you can get that information. But let us know. The more information we have, the better I think we can educate and help people.
We truly enjoy doing this. This is fun. And it's educational for us, too. It goes the same way.
And obviously, as you guys can see, second episode, we are not professional speakers. We're not actors. We are learning this as we go. So have some patience with us. We have a lot of really good information to get out to you guys. Finding the best way of doing that and the best looking way and sounding way of doing that is something we're learning.
We're doing this for fun. So we're not quitting our day job. So
No. This is we're trying to help educate people. This is not. Although my kids might finally think I'm cool if I become a professional YouTuber or podcaster, that's as you can probably see, that's not in the cards for me. So I'm just doing this for fun and to try to get some education out to people. So thank you again for watching. Like, subscribe, follow, share, comment, etc. And we'll see you guys in the next episode.
Yep.
Ciao. Cheers.
Bye.